Let's get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast. All right, welcome to the Financial Purpose Podcast. I'm your host, Dale Shafer. This is episode 80. Thanks for stopping by. So last week, I had Abron Villegas from Lazier Capital on the podcast. We talked about the role of operating capital in your business and why it's important as a cash flow function. And so I want to follow up with that because we talked about KPIs, so key performance indicators in the business. And I think sometimes it can be kind of tricky if you've never done this or you haven't really managed KPIs in your business, or if you do manage KPIs, it can be helpful to have a quick conversation about, hey, what are we tracking? Why are we tracking it? What should we be tracking based on our business and the kind of results? And so I want to go through that real quick. This should be not a long podcast, but I'm going to give you some real world examples of how this works using Life Moves Wealth. So I'm gonna give you some of our KPIs and how we're tracking, just so you can kind of get the feel for it. And then I'm going to give you 4 KPI categories that every business owner should be tracking. It does not matter what your widget or service is. These are going to be things that are going to help you drive your business, not only your business results, but also your business decisions in a way that leads to higher profitability for yourself and for your employees, and for what you're doing. So right off the start, the reason to do this, I would say, is you can't improve what you don't measure. And so you've got to measure. There are a lot of business owners that fly blind for a period of time, meaning you don't look at your numbers until there's a reason to. So usually, as we talked last week, it can be you're getting to the end of the year. And so now you're starting to look at your numbers, or you're getting close to tax filing, which we just went through, and now you're going to start looking at your numbers. So if you want to grow, scale, improve, drive, attract talent, attract investors, attract potential transition options, you're going to need a really good, clear view of the numbers that really matter. And so this should help you build a KPI dashboard if you don't already have one. And yeah, we'll get started. So I'll also say that there is a partner blog post for this on lifemoveswealth.com. And you can find it very quickly, lifemoveswealth.com/KPIs. And you'll get to that, or just right on the front page, you'll see it. So anyway, all right, the first thing that you want to do when you're setting up your KPIs and understanding what you're tracking is tie the KPIs to your business goals. So start with what you're trying to achieve and why. If you're looking for things like, as an example, if you want to boost revenue and track revenue growth, naturally, I hope naturally, what you're going to look for is you're tracking new sales, you're tracking conversion of your pipeline, you're tracking leads that are coming in, source of those opportunities, because that's going to help you understand marketing spend and marketing efficiency and how much of your revenue is tied to marketing activities and how much of those marketing activities are converting into opportunities and how many of those opportunities are converting to revenue earned. And so revenue growth is an important one for any business. If you want to improve profitability or know what your true profitability is, you're going to want to track gross margin, net income, cost controls, revenue per job, margin per job or per inventory item or per service line, whatever it is, you're going to want to track what happens when a dollar is produced, how efficient is that dollar, or when a dollar is received, how well is that dollar then converted into profit? And so that's a very important metric as well. If you're looking for setting up an exit strategy, which as any business owner should be doing, beginning with the end in mind. So how you run your business today indicates what the end of the line for you, whatever transition method you want, that's where you're driving to. So I'm forgive me. Let me rephrase that. Beginning with the end in mind as any business owner, whether your transition is 2 years away or 20 years away, or you're going to have to be taken out in the box because you're never going to stop working, whatever that looks like. Whatever you want your transition to look like determines how you should be running your business today. So if you want to take your company public, you better be running it like that is your end goal today. If you want to transition to a family member, start running your business like that's going to happen today. If you want to go to private equity, or you want to sell to a management team, or as LeBron was talking last week, if you want to do an ESOP, you need to run the company today like you're headed toward that goal. So for exit strategy, you need to be tracking enterprise value drivers like your EBITDA, earning before interest, taxes, deductions, and amortizations, customer retention, seller discretionary earnings, book value. Those are the things you need to be looking at as a business owner. And if you don't know how to calculate those things, send an email to info@lifemoveswealth.com and I will give you the quick formulas. This is simple stuff. It's very, very easy to do. You just have to know what things to put into the formula. And it's just all division and subtraction and addition, and it's basic stuff. And these are the things you should be doing. So if you're looking to set up your business for transition, you're going to have to unlearn some of the old ways of doing business, like the one that I talk about all the time, which is, number one, treating your business like a lifestyle business, which means you're living out of it and running a lot of personal expenses through it. You need to stop that. And you need to make sure that you're not functioning on driving down net profit every year, because driving down net profit is going to harm the ultimate valuation of your business, and it's going to be counterproductive to what you want as an exit strategy. So if you're looking for exit, start running your business profitably on purpose, for a purpose that will be played out at a later time, and you'll be rewarded for it. The second thing that you want to do to set up your KPI dashboard is organize it by the business function. So you want to group categories of KPIs into where they need to be managed, which part of the business is responsible for those. So for example, sales and marketing, their KPIs, so whatever your sales team looks like, lead to customer conversion is a big one. Average deal size is very important. Which opportunities are converting based on which services? Where do you have higher margins? Where do you have higher cost? What type of services are your loss leaders? Do those loss leaders lead to additional sales opportunities? Right. So you want to make sure that you're tracking those kinds of KPIs. And another big one, cost of acquisition. I think that this is one that is easy to kind of ignore, and not even ignore, but just not even be aware of. What does it cost you to turn a lead to a customer? That customer acquisition number is very important as well. All right. Operations, your KPIs are going to be things like inventory turnover, project completion rate. Some of it's going to be how cash is flowing over to the finance department. Some of it's going to be process oriented. It's going to be everything from the order comes in, the order gets acknowledged, it gets assigned to a crew or a salesperson or a fulfillment center, whatever your operation is. And then how it gets tracked to the customer satisfaction. All of those things are going to be put into an operations KPI dashboard. For finance, you're going to be looking at all the numbers, and these are like the things like gross margin, operating cash flow, accounts receivable days, inventory turnover rates. You're going to be looking at your current ratio. You're going to be looking at your return on assets and your net profit margin, things like that. If you're customer service or some sort of, customer facing contact center or whatever that is, you're going to be looking at churn rate. You're going to be looking at call response times. You're going to be looking at, repeat purchase rates. You're going to be looking at customer satisfaction scores. You're going to be looking at average time on the phone if you're running a contact center, and average minute per profit, and all sorts of things that are profit per minute. However you're doing that, those kinds of things are going to show up on your dashboard. Now, you really want to just kind of start in each of those areas because it's very easy to blow out and look at 25 things. I have a spreadsheet that looks at like 30 different metrics on a business, and all I need is a P&L and a balance sheet, and I can give you about 30 different data points on what's happening in your business, from ratios to operating margin to cash flow to book value to days receivable turnover to inventory. All this, it's a lot of stuff. Like it's net present value of the business and your all sorts of things. And so if you want to look at that, I'll be happy to do that analysis with you and your business, so that way you can see it. But let me just give you a couple of things, because you want to look at just like 2 or 3 things for each category. But I'm going to tell you how easy these ratios and calculations are to produce for your business. You can literally do this in a minute or 2 with a very simple calculator. You can do it on your phone. You can do it with a desk calculator, whatever. You can put it in Excel, whatever you want to do. So, for example, if you want to track net profit margin, you're very simply going to take your top line revenue or your sales and divide it by your net income. So if you're looking at your P&L and you're not clear on where those are going to line up, your net sales or your net revenue, total sales, total revenue is going to be the first bold number usually that you're going to see on your P&L. And it's going to say total sales, total revenue, something like that. Flip the page over, and the very last number that you see is going to be your net income. And so you're going to divide those 2 things. If you want to track your return on assets, which is basically saying for every asset that you own, how many dollars of profitability is that driving for the business? What is the asset's economic value? So if you're making a decision like, hey, we need to buy another truck or another vehicle or another van or another service center or another building or whatever it is, this is going to help you understand what that asset to the business will deliver for you in return or profit per dollar of that asset. So this is an important one to check as well. So you simply just do that. You take your net income and you divide it by your total assets, and that's going to give you your ROA, or return on assets. Your current ratio, every business needs to be tracking this. Current ratio tells you if you have a business that has appropriate amount of liquidity or if you're into a cash crunch. And your current ratio is simply you take your current assets and you divide it by your current liabilities. And we talked about this last week with Abron on the episode about operating capital. And the thing with current ratio is that you have to understand that current assets is anything that can be converted into cash in a short period of time, which is less than a year, and any liability that needs to be paid within that year. And so that's going to be current payments on credit cards. That might be short-term financing things. That may be current debt payments, things like that. You divide those 2 things. If you have less than 1 as your results, so if you divide current assets by current liabilities, and you have a number that's less than 1, that means that your business is in a cash flow crunch. You do not have enough liquidity to service your assets you don't have enough current assets to service your current liabilities within the given year's period of time. You're going to have to make some adjustments to how you're spending money, maybe stretching out your payables and receivables like we talked in the last episode. You're going to have to make some operational changes to bring your current ratio above 1. 1 or above is good because that means that you have enough money to fund your activities for the year or in the current ongoing business operation. But you want to be higher, as much above 1 as possible. If you get too far above 1, then you just have too much cash laying around, and we should probably put that to work. So there is some art and some science to managing your current ratio, but every business owner needs to be looking at this on a regular basis. This is a very important one. And actually, if you take that current ratio and you convert it to dollars instead of a factor, that's going to give you your working capital, which is what we talked about on the last episode. So that becomes helpful for you to know as well. And then the last one I'll give you real quick, average days to collect revenue. This is a very important number because this goes into, again, the last conversation when we're talking about how to properly structure and improve working capital. Part of that is in how many days does it take you to collect revenue and how many days does it take you to pay your bills, and how can you make a little bit of arbitrage between those two to be efficient for yourself. And so all you do there is you take your sales number and you divide it by a factor of your accounts receivable divided by 365. And your accounts receivable is going to show up on your balance sheet. Your total sales is going to show up on your P&L. And that's a very easy calculation to do. But this is a very important calculation to do because if you find that your invoice terms are net 20 to your clients or customers, and your average days of collection are higher than that, then you have a problem with collections. You have a problem with people paying you on time. And so then you need to address that with your clients, with your salespeople, with your operations team, with your finance team. Maybe you need to have somebody who is calling on past due invoices. And that can be a very telling number. If you find that if your terms are net 20 and you find that your number is lower than 20, maybe you shorten your terms because it means that people are paying you more efficiently anyway. And so that allows you to stretch your margin between when you're receiving money and when you're paying your bills. So that can be very, very helpful as well. Okay, step 3, use the tools that you already have at your disposal to do these. You don't have to go out and spend a lot of money on software. You don't have to increase things. You don't have to hire a whole other person just to track these ratios. You can do this. You can use QuickBooks to help you pull this information. You can use Google Sheets. You can use Excel. You can use your CRM or your project management database if you have one. You can use ChatGPT or Perplexity or Gemini or whatever your favorite AI tool is. You can use those things to do this. In fact, to prove that was possible, I took the 2023 P&L and the 2024 P&L for Life Moves Wealth, threw it in a ChatGPT, and I had a very simple prompt. And the prompt was, analyze these two financial statements and give me year-over-year KPI comparisons. Very straightforward. So I'm going to share with you what it gave me, and this was very, very helpful to me. Now, I look at these numbers all the time, but sometimes it's helpful to go, oh yeah, that's why that number moved this way, or yeah, that's why that number moved the other way. So here's what happened. First thing it gave me was revenue growth. So I, from year 2023 to 2024, had a revenue growth at Life Moves Wealth of 37.7%, which is strong. That's strong growth. It shows positive momentum. It shows great scalability. And for what it's worth, it also shows that people are attracted to what we're doing because we have a completely different approach to wealth management than most advisors, and the word is starting to get out. And Life Moves Wealth is by referral only. I mean, we don't do advertising. We don't do a whole lot of networking. We have, close associates that we work with in local area. And we have clients and we have people who send people that they care about to us because we do great work. So good growth year over year. Then net income, only growth of 1.6%. And here's what it told me. Despite strong top line growth, bottom line profit was nearly flat. Time to assess where expenses grew. Now, I know where expenses grew, and it actually pulled it out. So I'm going to put a pin in that. Because there's a legitimate reason for why that happened year over year, and it's going to tell me in the next one. So I'm going to pin that. It told me third, my net margin. So net margin in 2023 was 39.2%. Net margin in 2024, 28.9%. And here's what it said. Margin compression is a red flag, and it is. We definitely want to watch this unless there's a strategic reason for margin compression, and sometimes there are. So here's what it said. Higher revenues didn't translate into proportionate profit, likely due to added overhead, example, payroll, software, and travel. Well, here's what happened in 2024. I made an S-Corp election, so I had to put myself on a W-2 income. I traveled to see out-of-state clients, which I did not do in 2023, and I added some software costs to continue to improve the service to business owners in particular. So I have my financial planning software. I have my CRM software. I have my Now I have my business uh, intelligence software. And so there's a lot of really cool things there. That all cost money. So that's why margin came down, is because I spent money that I didn't spend in 2023. Now in 2025, the margin has actually come back up because I've made those adjustments. Revenue is still growing. And so it looks pretty good at this point. Now I did in the first quarter, spent a fair bit of marketing dollars early in the year on the Business Transition Summit, and Life Moves Wealth was a part of that. We were a sponsor. I moderated a couple of panels, and so that will mess with your margin as well. So if you just look at the numbers, you're like, oh my gosh, margin is down. You've got to be able to tell a story behind the numbers for the numbers to make sense. Okay, next thing it gave me was operating expenses, which were an increase in 2024 of about 65%. And again, that's a function of travel, payroll, and some marketing expenses and some software. And it called out, it said expenses grew faster than revenue. The largest increases were in payroll, software, travel, and meeting expenses. And meeting expenses is tax treatment that the CPA and I worked on, because a lot of my meetings involve traveling somewhere and sitting down. Usually there's food involved, and we're talking about business, and we're doing some financial planning, and it's often around, we're bringing in coffee, we're bringing in, we do working lunches and things like that. So we change those to meeting expenses rather than entertainment. Talk to your CPA to see if something like that makes sense for you. But for us, it made sense. And that's a tax treatment thing for us. Number 5, it gave me owner's discretionary spending, which increased by about $3,000. Not a big deal. But that's because of a shift in client travel, meeting expenses, vehicle use, things like that. So that was just a small increase. Nothing to worry about there. Again, tax planned increase for the business. The 6th thing it gave me was software as a percentage of revenue. And in 2023, that was at 18.2%. Software is my biggest line item after payroll. It's just expensive to run the software that I do for the reasons that I do it. In 2024, that number dropped to 14.7%. So it's still a large item. But I had to be sure, and I did this in 2024. I went through every piece of software on a whiteboard, mapped it out with a client flow. Like when does this piece of software intersect the client experience or the financial planning process? And if I was finding that it was redundant or it wasn't helpful or it was just there, it got removed. And so things in my software expenses, again, are things like my financial planning software, my Elements dashboard, my business intelligence reporting, my ChatGPT, my Microsoft, my, those kinds of things, that all gets kind of plugged in there. And so it's important to see that. But here's the thing. Context is very, very important, because I had a decrease of almost 4% in software costs, but that wasn't necessarily because I cut some software expenses. And I actually did in 2024 cut software from 2023. But that number moved down also as a function of my revenue increasing. So as a percentage of revenue, my software cost went down, and that should be expected. The more revenue that you increase, if you're efficient, you shouldn't see incremental increases in these costs unless those costs are needed to fund the revenue. And that's where we have a cost of goods sold conversation. So anyway, and then the last thing it gave me is a percentage of revenue, payroll as a percentage of revenue, which is currently at about 17.5%. It's actually going to be a little bit more this year because it'll have a full year of payroll, and 2024, I started payroll in the second quarter. So anyway, it tells me you added payroll, which is fair for a solo practice or lean team, but watch how it scales. And that's absolutely appropriate. And then it gave me a couple of high-level takeaways. And so that was really helpful. So anyway, all of that to say, you can do this. You can use the tools that you already have at your disposal. And ChatGPT is a great one for just quick and dirty analysis. You can also put these ratios into Excel, and just knowing what you divide, you just plug those numbers in. And again, I can send you my template if you really want to. It's very complicated. It's nerdy. There's a lot of stuff to look at. It probably wouldn't be that helpful to you. but I'm also willing to help you understand what you see there. So, all right, back to the KPIs. Step number 4 that you want to do to build your KPI dashboard is to set your benchmarks and targets. Tracking alone is not enough. You need context for what you're looking at. So you want to compare it to prior performance, as I did. I wanted to see 2023 to 2024. I could have done it 2022 to 2023 to 2024, and those numbers would have looked great because every year, knock on this wooden table here, and by the grace of God and by good work, Life Moves Wealth is continuing to grow and attract new clients and bring on revenue. And but it's important to compare that past performance and then to understand what happened, what decisions were made to drive those results. So you need that context. You also want to use industry benchmarks for your business. So you can get this information from a trade group. You can get it from a supplier or a vendor. You can also get it from your competitors. Because as I've said before, there's no harm in taking a competitor to coffee or to play golf or to have a cigar or to do whatever you're going to do. You guys can talk shop and be competitors, but you can be frenemies, right? And understand each other's business, and you can learn from each other. And maybe at some point that becomes a great way for you to have a synergistic takeover of a competitor. Maybe you guys merge. Maybe you buy each other out, or one of you buys the other out, or whatever you're doing. That can be very helpful, but to understand your industry, because what you don't want to do is be in one industry, have your numbers and try to compare yourself to something that's completely different, because that's not a great comparison and that's not going to be helpful to you or your business. And then you want to set realistic, goal-oriented targets to guide your team. And you want to get your team, it's easy to say, get them on board, but getting them on board, when you just say that, that is almost more like authoritarian than it is collaborative. You want to get your team involved in the success of the business, participating in the success of the business, not because you've told them to, but because they understand the vision of what the business is trying to accomplish, and they have bought into the vision. They're carrying the vision. They're stewarding the business as if it's their own, and that's how you build a great culture. That's how you build great loyalty. And it's how you build a lot of profitability in your business. And it's how you reduce things like turnover and people stealing from you and people being careless with your products or your equipment and things like that. So the goals have to be realistic. The people have to be able to envision where you're trying to go to. And then they have to understand how their part plays an important role. Everybody wants to feel like they're contributing at an important level. Help them understand how what they do drives you to that goal. Number 5, and this is the final thing for building your KPI dashboard. Every KPI dashboard, and even the KPIs that you're tracking, should evolve with your business. As your business grows and scales, and maybe you shift focus a little bit, your KPIs are likely going to change. And maybe you need to track different things for different reasons, because the bigger that your company gets, the more things you need to look at. And there are different things that you need to track with different levels of priority. So you should review your KPI dashboard at least monthly. I highly recommend that you're tracking on a weekly basis. You're making monthly decisions, because 1 week should not make or break your business. You can have really, really great weeks that set up your year. You can have really, really bad weeks that set up the next couple of years. And so you want to be tracking this regularly so you can adjust where you're going. It's just like running a GPS for your business. If you're not running it all the time, you might miss a turn. And so it's very important to be updated as often as possible. And then ideally, you want to have a weekly stand-up meeting with your leadership team, maybe with your sales team. Maybe it's an all-call, depending on the size of your business. And it can be very simple. It can be 10, maybe 15 minutes. Here's what happened last week. Here's what we're driving to this week. Here's why this is important. What questions, what obstacles do you have in reaching these things? Where are you winning? As the leader, where can I help you remove obstacles? Who can I call? What can I do? You do those kinds of things. As your business grows, there are going to be some metrics that you originally watched. you might drop those and pick up new ones. And so in your business, be sure that you don't have sacred cows that prevent you from tracking the next important thing. And then use that dashboard, use your KPIs to inform real decisions, not just reporting numbers. So it's good to track numbers and it's good to have a dashboard. But if they're just numbers, then they have no purpose. So you need to take those numbers and know, number one, what are they telling you about your business? Number two, how are they informing the next thing that you need to do? And number three, how do you turn them into profitable decisions for your company? And then I'll add a fourth. How do you make sure that everyone in the company understands those numbers too? And that can be very important, because it's one thing for a leadership team to be like, we're going to keep our financials close to our vest, especially if you're a privately held company. If you're a public company, anybody can see your financials. That's public disclosure. But if you're a private company, you're going to be like, well, I don't want those guys to know how much money we have in the bank. Okay, that's fair. You don't have to open your bank books to your employees unless you really, really want to, and you have that level of transparency. But you should open up your financials to the business, because your employees are stakeholders, and your ability to run the business well and their ability to contribute at a meaningful level matters to them, because it directly impacts their livelihood. And so I think it's important for your employees to understand that the business is being ran well. And if they understand that the business is being ran well, they're going to be more loyal to you as a leader. And the best way to help them understand how the business is being ran is to show them the results. And you want to do this, you can do it by having just a leaderboard in your office, or a sales board, a whiteboard where you're tracking, who's selling what, or what work was produced, or how much revenue came in for the week, whatever. But you also have to help them understand the other side, which is the liability side. If this much money came in this week, this much money has to go out for these purposes. Help them understand the business decisions, because then it doesn't produce conflict when they say, hey, I need a fill in the blank. That requires you to spend money. If you, the business owner, goes, sorry, cash is tight, I can't do it, but they see only big numbers, they're going to have a lot of questions, and rightly so. And it's going to create a lot of confusion, and it's going to create distrust. And distrust in your business is a profit killer, because if your employees don't trust you, their performance is going to suffer. Their performance suffers. Your CSAT, or customer satisfaction scores, will suffer. Your process efficiency will suffer. Your cash flow management will suffer. Your profitability will suffer. Your sales will suffer. And then eventually you're going to end up in a position where you have a company that's just not very good, and not easy to run, and not fun to run anymore. So know your numbers, build your KPI dashboard. Go to lifemoveswealth.com and look at the partner blog post. There's actually a couple of little tables that you can use. And I added in the blog post, I added these results. So I'm being very public about how I'm running Life Moves Wealth, because it's important. It's important for clients to know that I'm running the business well. It's important for the partners that I work with to know that I'm going to be around for the people that they want to refer to me. It's important for clients to know that I'm going to be around and have a business that's going to be there, and I'm not going to run myself dry. And so I think it's important to have public results, and to grow in public, and to be able to share that information. That transparency level is important to me, not only as just because I think it's important, but as a fiduciary advisor, I think it's incredibly important to be transparent about what I'm doing over here, because what I don't want is for clients to be like, man, this guy's just like, he's just taking all my money and sucking it out, and what's he doing with it, right? Well, I'm running a business, and I'm trying to run a business that's very profitable. I am not trying to drive down my bottom net number. I'm perfectly happy to pay taxes, because it's going to help me be bankable, which is important if I want to grow to the next level. Or let's say if I want to go out, one of the things that I want to do so bad for Life Moves Wealth is to buy a tax practice and bring tax planning in-house and have it be synced up perfectly with our other financial planning and business financial planning objectives. Tax planning is key. And sometimes it can be very hard to find a good external partner. So if I bring that in-house, Well, I might need to go get an SBA loan to buy the tax practice to bring those people in. Maybe, or maybe I attract private equity to front the money to do that initiative. I need to be bankable, and to be bankable, I need to be profitable, and I need to show it on paper, and I need to have good ratios. And so being bankable as a business is incredibly important, and a lot of us aren't because we're getting bad financial advice along the way. And so what if you save a couple of bucks in taxes? It doesn't matter if you then can't function or fund your next level of growth because you're too busy trying to save, a couple of cheap dollars on taxes. And I'm going to tell you that cheap dollars saved on taxes are worth significantly less than investable dollars into your next level of growth. So show your profit, be profitable, know your numbers, build a KPI dashboard, and be public about what you're trying to do, because you will have people who will join your vision and help you be successful if they believe in what you're trying to do. So if you have questions about how to set up your KPI dashboard, if you want me to look over your business financials and show you how financially healthy you are, we will parlay that into your personal financial health, and we'll manage those two things together because they are very symbiotic. Or, as you've heard me say 100,000 times on the podcast, it is financial spaghetti. Once it goes into the bowl, everything touches and everything is in the bowl already. So let's manage it correctly, and let's do that. But go to lifemoveswealth.com, click the schedule button, and I'll be happy to do that. You can also send an email to info@lifemoveswealth.com to start that process and just say, hey, send me your calendar link. I want to meet with you. And by all means, do go check out the partner blog post, because you can print that, save it, copy it, paste it, whatever it is helpful to you, and get yourself further down the road with better business intelligence. So that's all I've got for you guys today. Until next time, go be a boss, go be financially awesome. Take care of yourself. See ya. Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.